So we move to Chapter 17, Investment Appraisal, a very important chapter for us for the MA exam and indeed going forward in your ACCA studies. Investment appraisal is a key area. Not overly complex, but takes practice to get it right. Let's take a look at this first section and indeed the area of relevant cash flows. Firstly, let's talk about investment appraisal. So what do we consider when a business is looking at an investment or trying to appraise? In other words, assess whether or not it's going to move forward with it. Well, there are a variety of areas. Firstly, there will be some sort of setup or initial investment. We'll have to expend resources, cash in some way now. Outside of that, there's very likely to be annual running costs year by year in several different forms. We certainly hope there'll be income generation. We're making investments, obviously, to make profit and to derive income. It may well be also that there are savings. We make savings as a result, a direct result of making this investment. Linked into that, as mentioned, this investment is going to take place over a series of years. There's going to be some sort of useful life. And indeed, linked to that, it may well be that within the initial investment, we purchased equipment, and it could be that some equipment provides us with some scrap proceeds, or if you will, a residual value. So really, in terms of considering investment appraisal, we really got to look at all of these areas and bring them together with, suitable techniques to assess whether or not these investments are worthwhile, whether or not we want to move ahead. Now, cash flow and profit, again, this is an area really that we need to be on top of. When we think about investment appraisal, more often than not, we're talking about cash flows. And let's note that there's a difference between the accounting profit of a business and indeed the cash flows of the business. Broadly speaking, when we think about investment appraisal, particularly the go-to techniques, so net present value NPV or IRR, we're not interested in accounting profit. We're interested in inflows, money coming into us, let's say in the form of sales or revenue, and outflows, expenses, setup costs, etc. So let's be careful about non-cash items that have nothing to do with cash coming in or indeed cash going out. Moving on from there, when we think about flows or relevant cash flows, it's important that when we assess investments that we only consider relevant cash flows. What are they? Well, they are cash flows that occur directly from the decision to invest in something. For example, a new machine costs $10,000. Therefore, that's a relevant cash flow. That's cash going out. In terms of other examples of relevant cash flows, certainly the initial setup costs, running costs, and indeed outside of that, certainly the cash flow that the investment will generate, in other words, money coming in, and possibly some cost savings. Now, note, as it was referred to in the Study Hub chapter, that relevant cash flows are just that, they're cash. They're invariably incremental, and they're most likely absolutely in the future. Those three areas are important. If you were asked to define a relevant cash flow, it's going to be cash, it's going to be incremental, and in the future. Now, in terms of investment appraisal and the time value of money, you'll be familiar with the concept that really an investor would prefer to receive $1 today than $1 in 1 year, simply because of the value of money, or if you will, the time value of money. Now, there's various reasons for that outside of the obvious, i.e. that $1 today is worth more than $1 down the line because of inflation. It may well be that investors have a liquidity preference. In other words, that they have a preference for having money today as opposed to in 1 year or 2 years, etc. Outside of that, certainly risk is relevant. Future cash receipts may be uncertain. It may well be that we think, well, we get $10,000 in 3 years, but perhaps we won't. Cash today is safe. Inflation, as just mentioned, in terms of today's prices, is certainly relevant. Money, or the value of future cash flows, is certainly eroded by inflation. So this area of the time value of money is important, and indeed discounted cash flow, or DCF techniques, take into account the time value of money. And that's critical because we're getting realistic numbers. Moving from there, when we think about DCF, you'll be familiar, I expect, from having read the Study Hub chapter and indeed perhaps former studies, that we have several different possibilities in terms of discounting cash flows. In other words, bringing future cash flows back to now. The go-to technique, both certainly within the ACCA qualification and indeed in real life, is NPV, or net present value. More of that throughout this particular mind map. Next key area is IRR, or the internal rate of return. More of that later. And then indeed the last one, probably less well used but often examined, discounted payback. More of that in a moment. So 3 main DCF techniques that really take into account that crucial area of the time value of money. If you're making investment appraisal decisions and you're not taking into account the time value of money, it's possible that you may make an incorrect decision, or not an optimal decision. In terms of tabulating cash flows, I haven't cut in anything from the Study Hub. I think tabulating cash flows is quite straightforward. Really, we're talking about how we present. How we present, for example, let's say an NPV calculation in terms of rows, columns, etc. Quite straightforward. Now, in terms of present value and investment appraisal, we've talked about the time value of money. And indeed, what we need to do is obviously to use a technique. So to use discount tables, depending upon the year and depending, of course, upon the cost of capital. Now, let's be aware that the choice of the discount factor is very, very important, particularly, for example, in the area of NPV. And that cost of capital may well be the business's cost of capital. And just as a reminder, when I say the business's cost of capital, I'm obviously talking about the cost to the business of raising finance, whether or not that's debt or equity or a combination of both. Now, in terms of NPV and delving deeper into NPV, what we know is that basically NPV as a definition is really the sum of the present values of the investment's relevant cash flows. For a given investment, we're going to have a series of cash inflows and cash outflows. And what net present value does is really to say, let's bring all of those cash flows back to now, or back to T0 in effect. Now, in terms of what NPV considers, clearly there's several areas, not least obviously initial setup, although it's not mentioned, the outflows, the inflows, and indeed the time value linked into the discount factor. So what about the formula? The formula is fairly straightforward. We're simply looking at PV times FV times DF. So we're simply looking at the future value times some form of discount factor, okay, that may well be linked into the cost of capital of the business. Okay, so working out, the present value of a given number is actually quite straightforward, and once you've done it, if you haven't done it already several times, you'll find that it's quite easy to do. But do remember, obviously, that investment appraisal decisions are made up of a series of different cash flows and a series of different years, and we've got to be familiar with how to use these formulas. Moving from there, in terms of assumptions, okay, this is quite important. We're going to say that cash flows occur at either year start or year end. Certainly today, right now, is year zero, okay? And year zero, note, means the point of the first cash flow. Now, more often than not, 9 times out of 10, that will be the initial outlay or the initial setup costs. So you'll have year zero or T0, perhaps, let's say $500,000 going out, setup costs, and all of the cash flows from year 1, 2, 3, etc. Now, in terms of templates, I've just taken one template. This is the simpler one, but you get the idea here. One thing that's important, when you're laying out any investment appraisal calculation, and certainly NPV, is your formatting. The more neat, the more well presented you are, the easier it is, trust me on this, and indeed, the easier it is if we're talking about a written exam for someone to follow it, i.e. a marker. This is a simple template, as you can see here, the year, the net cash flow, the discount factor, and the NPV. So let's say we're looking at year zero. Let's say we've got a setup cost going out. If it's year zero, the discount factor won't be relevant. The amount will go straight across. And then let's say year 1, net cash flow, discount factor, etc. Okay? So what we're always aiming for within NPV is a net present value. And note, obviously, within NPV, if we have a positive net present value, then that project is worthwhile. If we have a 0 net present value, we're nonplussed either way. And if we have a negative net present value, then we should not go ahead with the project. Note that NPV is very much linked to shareholder wealth maximization, given that it's the go-to technique very often, not just in the ACCA qualification, but also in real life. So the idea of going ahead, let's say with an investment appraisal project that has a negative NPV doesn't make sense. We're always looking for more than 0. Okay? Now, in terms of the calculation, you'll see from the study hub, the calculation is fairly straightforward. We move from a set of cash inflows and outflows, including, let's say, a setup cost, through a discount factor to a value. Do practice the questions, do practice the activities. As I've said, we can't avoid it. We're happy to fail in these questions. It's a little bit tricky here and there, depending upon the type of trick or trap, if you will, that the examiner brings in. Don't avoid the questions. Now, in terms of the target rate of return, or if you will, the cost of capital, I mentioned it up top. It says here that the cost of capital is usually the discount rate used in NPV calculations. I would agree. Now, why is that? Well, several reasons. Number one, as mentioned up top, the cost of capital is the cost of financing the business through the form of, let's say, debt and equity. That's number one. Now, if we're financing ourselves at a particular cost, then it makes sense to appraise investment appraisal projects at that value, because obviously if it's higher or lower, we're going to make decisions on that. I guess the other area here is ease or simplicity. It's more simple to use the cost of capital than something else. But be careful, because let's think about it. If we're taking on a very, very risky project, it's highly likely that we should use a cost of capital that's higher. Because if the project is risky, we want to discount the cash flows that little bit more. So it's not always the case that the cost of capital of the business, i.e. the cost of debt and equity on average, is the best and only option in terms of a discount factor. Moving from there, in terms of the effect of cash flow timings on NPV, we'll know, given what we said about inflation, that really, the further away a cash flow is, the less it's going to be in NPV terms. If the cash flow is, 7 years away as opposed to another cash flow is 2, then clearly we're going to be discounting further. So note, obviously, further cash away, lower the amount or impact upon NPV. Now, next area is, as shown by the hub, is just practice. As I said earlier on, we have to practice. Let's do the questions. Okay, now in terms of the advantages and disadvantages of NPV, as I've mentioned, it is the go-to technique. Certainly within the ACCA qualification and certainly within practice. It considers the time value of money. That's a big, big plus. Outside of that, it's interesting that because it provides an absolute measure of return, in other words, it gives you a value, it's very, very useful because we can compare projects of different sizes. In addition to that, we certainly wouldn't want to be using an investment appraisal method that focuses purely on profit, because we know from our studies that profit can be manipulated. NPV focuses on cash flows. These are real. This is real money. You can touch it. Profit is subjective, and also, as we know from accounting studies, it can be manipulated. In addition to that, the NPV is an investment appraisal method, unlike, let's say, payback, which considers the whole life of the project, years 1 to 4, years 1 to 8, the whole life. That gives it an advantage. In terms of disadvantages, there are some. It may well be that financial managers find this slightly difficult to understand, although broadly speaking, it's linked to sort of time value of money and inflation. In addition to that, and probably a much, much bigger concern with NPV, is the discount rate used. As mentioned up top, more often than not, the cost of capital will get used. But what if the project has a higher degree of risk than our business? Or what if the project, at the end of the day, is much more risky than we thought, and we're using a discount rate that is out of place? Moving from there, in terms of an area linked to NPV, the internal rate of return. Now, what do we mean by this? Well, basically, thinking of NPV, we saw that we have within NPV a series of cash outflows and cash inflows, perhaps a setup cost, a discount factor, and we're really looking for investment projects that provide us with a positive NPV. So what does IRR do? Well, as you can see here, it is the discount rate at which the NPV of an investment is 0. Okay? So in terms of the decision rule, let's be clear. If the IRR as calculated is greater than the cost of capital, the project returns higher than cost of capital should be accepted. Flip side of that, if the IRR is less than the cost of capital, obviously the reverse is true. The project returns lower than cost of capital, it should be rejected. Make sure that you have a fix on this for sure. We need to be able to do the narrative or discursive questions as well. And certainly IRR lends itself to narrative as well as numerical. Now, in terms of the calculation, I think this is a little bit of overkill for us in terms of calculating IRR. I think within the MA exam, questions pertaining to actually calculating the IRR are limited. This is given, I believe, for illustrative purposes only. Okay? I'm more concerned, I think, for you in terms of theory. In terms of advantages, disadvantages of IRR, certainly IRR isn't as popular as NPV in real life, but will come up in exams. First advantage is the obvious one. Given what we said about the definition, it does consider the time value of money. So that's a big, big plus. In addition to that, it uses cash flows. We like that too. Now, it may well be, and this is a question of, this is subjective really, and perhaps easier for non-financial managers to compare against a target percentage. That may well not be so. It depends on the person, I think, but you get the idea because it's a percentage in effect rather than an absolute value like NPV. It may be that some financial managers prefer it. But there are disadvantages for sure with IRR. Given that it's a percentage, it ignores the size of the project. In other words, we're not talking about an absolute value, an amount. Outside of that, there are some issues with IRR. There may be the case where it may conflict with NPV. And in addition to that, where the cash flows are not as we described, in other words, initial setup out and then inflows and outflows, where they're not uniform in some way, it may well be that there's several IRRs. That makes things confusing both for financial managers and non-financial managers. So all is not completely rosy with the IRR side. Now, in terms of payback, our third area, let's look at simple first. Now, in terms of a definition, what do we mean by simple payback? It's basically a method that measures the time it will take for cash inflows to equal initial cash outflows. So we've had, let's say, T0, T1, some cash outflows, excuse me, and then we start to get in some cash inflows. So we're really looking for the time to recover those initial cash outflows. Very, very straightforward, quick and easy to use. The problem with it, obviously, is it's not considering the time value of money. Discounted payback does that. So basically, discounted payback, as you guessed, adjusts the cash flows, but uses the same method. In other words, the time on an adjusted cash flow basis to recoup initial outlays. So it solves one of the problems, biggest problem. Now, advantages and disadvantages of this area. Well, certainly the payback method, i.e. the simple payback method, is pretty straightforward. It's certainly easy to understand for non-financial managers. And indeed, at a low level, it's probably a fairly good technique just to see if you can, or how quickly you can return or have returned initial investments. But there are disadvantages, clearly, as mentioned. With simple payback, no time value of money consideration, which undermines it for sure. In addition to that, payback does not consider cash flows that take place after the payback period. Remember, it simply provides us with 2.5 years or 2.75 years, etc. So in one sense, that sort of undermines it. It may underestimate the value of the project. Outside of that, again, from a timing perspective, if there are significant costs later on in the project, it may well be that they're outside the payback period. Last area, short-termism. Well, it may well be that decisions, given that we're talking about timescales, let's say 2.5 years, it may well be that it encourages decisions based on short-term factors, just the recoup of initial investment, rather than something that perhaps is of long-term benefit to the company, perhaps a cash inflow in year 6, 7, 8, etc. So that's the investment appraisal chapter. Again, I think a mid-level technical difficulty chapter, but an important one. The only way to get better, as I keep saying, is to practice, and in particular, practicing NPV and indeed IRR questions. Okay? I hope that made sense and that your studies are going well. Thanks for listening.